So, hello traders. So this is the chat box. And yeah, so today we have a very fascinating topic. So I'm quite sure that you already joined the webinar together with Marcus in the morning show. And we were here announcing today's webinar on my top trading indicators for the year 2022. And I want to give you some insights into them. I want to show you how to combine them, in fact, in your trading. And what I try to do is, in fact, I want to show you, especially when it comes to our current run higher, especially in growth stocks, like, for example, a Tesla. Let's take Tesla as a perfect example after delivery numbers. And you probably have seen these vertical moves higher. And sometimes it's not over, but it's just the beginning of another sharper leg higher than after a short period of consolidation. And you probably have wondered, hey, how can I enter these trades? And the technique I want to show you today, respectively the indicators, if you combine them the right way, that's the first step in exactly this direction, in fact, and how to get there, how to enter these vertical moves in general, but also how to enter trending markets from a pure technical indicator perspective. In addition to that, I also like to answer a question which made it to my desk in the last minutes. In fact, it was on Fibonacci retracement. So in the morning, when I had the show together with Marcus, I opened my chart, and there was a Bitcoin chart, and I had several Fibonacci levels drawn into it. And that was probably the reason why this question was triggered. And I want to give you also an answer to this question here during the webinar. Probably this is of interest for several of you as well, in addition to the topic from today. And before we start, sure, I want to motivate you. First of all, to subscribe to the YouTube channel. If you watch the recording now on YouTube, feel free to subscribe to the YouTube channel. Set a reminder so that you don't miss any of the webinars and videos we produce for you. It's not just me and Marcus, but also our dear colleague, Paul, who will be here next Friday. And yeah, leave a comment in the chat box below. Leave a thumb up if you enjoy what you will see in the upcoming minutes here. I'd be happy in this case, especially, to answer all your questions you might have. And let me now share my screen. And first of all, let's go through the host, respectively, the company, the broker behind this webinar series, who makes all this possible. In fact, it's Admirals. And you probably have heard about Admirals already before. It's the broker who is former the company Admiral Markets, the same company, but there was a rebranding taking place. The question is now, why was this rebranding taking place? It's because Admiral Markets, respectively Admirals, started out as a FX and CFD broker, and is now one of the most recognized and probably one of the biggest and one of the hottest probably brokers out there, with over 8,000 financial instruments being offered. And it has a global presence around the globe, so fully regulated by several regulatory bodies like the SISIC, like the FCA in the UK, like the ASIC in Australia. Most recently, there was also a regulatory body added here from Jordan. You can also check all details on the website, therefore. And I'm located in Berlin, in Germany. So over here in Germany, we usually refer to Admirals as the DAX expert, in fact. So when it comes to DAX trading, but not just only DAX trading, but also FX trading, you will find one of the most competitive offerings, in fact. So from a not just order execution speed and reliability as a broker, but also when it comes to the overall trading conditions, when it comes to spreads, when it comes to tightness of spreads in this case, when it comes to trading commissions, and long thing short, just visit admiralmarkets.com / respectively admirals.com for further information. And so now we come to the rebranding part I just mentioned at the beginning. So the rebranding takes place due to the fact that on top of this brokerage offering, multi-asset brokerage offering, you find at Admiral Markets, you also have a broker who is now offering, for example, credit cards, plans to also build some business in the crypto space, and the crypto space here, blockchain based, for example. There's many plans, in fact, and it's a financial it's a global financial service provider, in fact, and that's the reason why this rebranding is taking place. Further infos again on the website admirals.com if you're interested. One world, one broker. So you can see here once again all the regulatory bodies and offices you can find around the globe. Very important for those wondering whether if English is not the native language, but it's another language, and you're listening to this webinar now, and you probably don't feel that comfortable talking to someone not in your native language, but in regards to some questions around financial products, which might be best for you, suited based on your character, based on your risk profile, and so on and so forth. I know that because I was in the retail banking sector before I started out in the trading industry. That's nearly 20 years ago, but still, I'm aware of the fact that this is usually sometimes a burden, or sometimes there are second guesses based on that. And this is a big plus here when it comes to a global, the global presences of Admirals around the globe, in fact, when it comes to the language barrier, which is not given in this case. And now let's have a look at today's agenda. So the indicators I want to present to you, I mentioned them already in the morning, will be the MACD. The MACD is this short. You will see what I'm talking about here. It's a moving average convergence divergence. We'll dig deeper into what it stands for, when to use it. We also want to dig deeper into the slow stochastic. There's an interesting side note here, and a little anecdote I can give you. That was in fact the first trading indicator I ever used when I started out as a trader, and I used it also as a professional trader back in my days as a in Germany, we call this Kursmakler. So it's like a market maker, you can call this, but I was quoting stocks, in fact, at a stock exchange. Then we will look at the parabolic stop and reverse. I use it in the morning. I showed it. These are the dots you can find on your chart. It's in fact, fully tradable trend following system. And then I'll show you how to combine the three. In fact, here you can see you combine 1 and 2, but I also added the Parabolic SAR here, and you will see how I do this. But before we start here with the first slide and on introducing the MACD, I wanna answer the question which was forwarded to me here based on this chart in Bitcoin. So let me just read out the question loud. So here, the question is, I'm wondering if time permits, could he spend, or Jens in this case, could Jens spend a few minutes on the accurate use of Fibonacci retracements and how to use them in trading? And sure, I can. I use, in fact, Fibonacci's for quite a while. In fact, this is one of the first tools you probably get in contact with when starting out as a trader. And especially when it comes to crypto trading, by the way. So this is just a personal feeling, but something which I came aware or came across over the last years. In fact, once the crypto space took on momentum, let's say, especially in the crypto space, Fibonacci's respectively a technical analysis in general. And here, let's call it basic technical analysis. So it's not just that we have some kind of pattern recognition, like, I don't know, Gartley patterns or bets or whatever it might be, but the basic concepts of supply and demand. Former resistance is new support, former support is new resistance, for example, but also Fibonacci's. They play really nicely out most of the time in the crypto space. The main reason for that is probably because crypto is an industry, respectively a field where many retail traders play around, let's say. So it's sometimes you can see that these concepts work out really well, and that there's some kind of, let's call it, self-fulfilling prophecy connected to that. That's one of the reasons why I use Fibonacci's, especially here in the crypto space. The chart you can see here, by the way, looks a little overwhelmed with or it seems a little overwhelming with lots of lines in it, but in fact there's just one which is of interest for me in my case here. So the reason or not the reason, but once I prepared this chart, it's a little ago, in fact, and I haven't updated it yet. So this is very important. So you probably recall here in December, that was at the beginning of December, yeah, over the weekend, we saw a flash crash over the weekend. And here then, given that flash crash, this drop massively lower here, this technical picture was not given anymore. Let's put it that way. But I was very interested in the region. In fact, that is not right, but I was really, really interested in this region here around. We just probably also enter. Do we have it here? No. Okay. I'm sorry. I want to include an ellipse here. Where do I have it? It's here, thumb arrow. In fact, I just want to. Where do you have it? Where do you have it? Where do you have it? That's a little unfortunate. Okay, let's do it that way then. Let's do it that way. So that reason here, that area here. So I will draw an X into that so that you can see it. So here, this area where you can see the X now in pink. I was very interested in this area because there is a so-called how can we call this in German? The word is yeah, it's also in English, and it's a cluster. So it's a cluster. And what I do is, so to draw Fibonacci's here, what I usually do is I take the low, an important low here, which in fact everyone can see. And here in this case, it was this area around, that's 28, something like that. 28,000, 28,500. That was the lows from May, respectively here, from June and from July. And we didn't drop that level, that region. I was back then. I remember quite clearly. I was a little skeptical, and I thought that probably we'll see a sharp flash out here and a drop below 30,000. And then things turn around. That was there was an announcement, something like Amazon about to hire a blockchain expert or something like that, which brought rumors on its way that probably Amazon is about to accept Bitcoin as a payment method, which is big deal. And then given that, we saw a sharp push higher. That was over a weekend, if I'm not mistaken, somewhere here. That was at the end of the month of July, and we didn't break lower, but instead we turned higher. Still, then there was a denial from Amazon, and I was like, okay, now after this sharp pop higher, we're probably about to see another sharper attempt to break lower here and break below 28,000, 28,500, which could then have opened the door to 20,000 and even lower. And instead, nothing happened, but we turned around and we saw a sharp rally, as you probably recall, and we made new all-time highs. That's the next relevant level. So a little story behind this, but that was an important region when it comes to lows. And then you take the highs here in this case. So it's not just these highs, but you can also work with these highs, even though once we push to these levels, this is not of interest anymore, this high here, but it's then the all-time high in this case. So you take the low here, you take the high, and then you can draw these Fibonacci levels. So 38.2, 50%, and 61.8. And given that, you can see here, this is the line, the long one. You can see this is around 53,000. It's the 38.2 level in this case. And then there's another quite significant low here. These are the September lows, from which we then saw the sharper push higher up to the all-time highs. This is the next level I take into account here. So the last relative low in this case, which is of interest here. So I'm not taking any swing lows, but I really want to see a relative high, a relative low to draw Fibonacci levels. So I take this low and also draw it as high as the all-time highs here. And what you can see there is that, and this is the second line here, which is obviously going back here to this area, is the 50% correction level. So 50% is not necessarily Fibonacci related, so we don't dig too deep now into how to calculate Fibs. But in this case, you can see that these two lines, or this region, really falls together. And this is bringing me now to a point where I say, well, if I have two Fibonacci levels here in this area, knowing that Bitcoin, respectively cryptocurrencies in general, are working quite nicely when it comes to simple technical concepts here based on technical analysis, I say, well, this is an area which I could imagine a reaction to happen against. And as you can see, or hopefully you can see that. So if we here zoom into this, you can see initially when we flushed into this area, whatever that big red candle here on the 28th, 26th of November was, 26, or let me just think. It was probably Thanksgiving, that was Omicron, that was COVID risk off tendency, something like that. That's probably the reason for this flush to the downside here. But whatever it was, you can see here Bitcoin respected this area. It respected this area, this zone, and bounced higher from there. So it wasn't that we took out then here this line around 60,000 or so. This is, by the way, a line I draw here for a German audience when I did a Christmas webinar here. But the thing is, we saw an initial reaction here. And then now the thing is getting interesting. I take these lows here and I then draw this trend line here, this blue one. And I say, you know what? If we now come back into this area and we don't, it's not just that we have Fibonacci retracements here, given the relative lows to the highs, respectively, the nearly yearly lows, or at least the mid yearly lows, the area which was respected around 28,000. But in addition to that, we also have this trend line here that brings us a big cluster, big support area against which I could imagine to go long if we hold. We didn't, obviously. So instead, we broke and we saw this sharp flush out then on the downside. Probably that was also triggered by many retailers then dumping their Bitcoin long position. Whatever the reason was, we can see that it didn't hold and we broke lower. But if it holds, then we have an area against which we can, based on Fibonacci's, for example, place a long order here and go long against this area. So it's not just how to draw Fibonacci's. I hope that this answers the question. So take significant areas. Hopefully everyone can see, and the bigger the picture you look at, so the time frame, the more significant a relative high, a relative low becomes then. But you can also combine several relative highs and lows in this context, and then draw clusters against which you then probably plan to build a position respectively, where you say, I have a level to risk against, because if we drop this level, then we are probably done and we are probably headed lower. So that's when I take out the position. And yeah, so I hope that this answers the question. And now let's come to today's topic and how to use MACD, respectively, the slow stochastic here. So first of all, let's introduce the MACD. I don't want to dig too deep, in fact, into the basics behind this, because there's plenty of stuff out there, many books, many articles. You can find articles also on the website, admiralmarkets.com, for example. They have a very, very detailed and in-depth section on technical analysis and basic indicators and how to calculate them and so on and so forth. Just check out the website. I just want to give you an overview of what these indicators are good for, and then use the knowledge here and combine it with other indicators and how to build a solid here. It's not a holy grail system, but it is a solid first step which you can use to combine indicators to then make your first trades based on them. So first of all, MACD stands for moving average convergence divergence. So it's obviously something with like converging, diverging lines or moving averages here. And what it is it's a trend following, trend capturing momentum indicator. So it's very important to know that once you use the indicator, because now you might probably say, hey, this is an oscillator, that's great. I use it when, for example, looking at trading a range or something like that. There are oscillators, or oscillators, especially like relative strength, for example, which are better suited for these market conditions. A MACD is not one of them. So the MACD is really a trend following, trend capturing momentum indicator. And it's also very important and there you can see why it's so important to know who you are as a trader, who you are as a personality. So what are you looking for? So if you say, I want to trade trending markets, it doesn't make sense to use an indicator which is suited best for, let's say, range bound trading conditions, and the other way around. If I want to buy the low of a range and sell the high of a range, for example, I'm a range trader, in the classic form. Well, it doesn't make sense to use an indicator which tries to capture trend following moves, or which is based on trend following an environment here in this case. So that's one very important aspect here, how to combine this also with your overall personality, with your character. And so what we do in case of the MACD, so this trend following, trend capturing momentum indicator, is we use two moving averages. So MA is short for moving average. And then we use the relationship between those two. So in this case, in our case, is what we do is we take the EMA, the exponential moving average, 26, and then we take the EMA 12. It's another exponential moving average. And what we do is we subtract these two from each other. And then we use, well, we could call it a signal line. Yeah, that's probably a good way to put it. We have a third exponential moving average. So you can already see, oh, well, if I use moving averages here, I take and build some let's say, mathematical term around it. Well, moving averages usually work well in trending environments. Well, obviously then if I use them as a basis for my indicator here in this case, well, obviously then it has something to do with trending. It's not working, or it's not suitable or suited for range-bound trading conditions. And then we take a third exponential moving average, aggregation 9, and here we have this is our trigger line, in fact, which is then responsible for buy and sell signals. So what we have here, this is the DAX. Most I just took the screenshot several minutes ago, so this is the most actual recent chart. And so you can see here a histogram. This is the difference between the EMA 26 and the EMA 12 in this case, so the difference. And then you see this moving average line here. It's the EMA 9, which is our signal line. So for example, once we here have an histogram which is positive, and we have an EMA which is in the positive territory, we are favoring long positions if you want. So that's one way how you could use it, for example. So for example, when going back here to, let's say, October 2020, for example, we saw a sharper drop, whatever that was. Probably something COVID related, or everyone is going skeptical again, lockdown, I don't know, whatever it might have been. And then you see a sharper reversal here. So there was kind of a, let's say, V we can see in the chart, and most likely that was triggered and driven by the announcement that there's now a COVID related, not drug, but a vaccine available. It's most likely this is the 9th of November, but whatever it might have been, you can see that the histogram turns sharply positive here in this environment. And then we start to push higher also in the EMA 9. That alone is not a reason to buy here in this instance. So because you don't know what will happen now and if it's a sustainable move, but it's the first signal, at least indicator oscillator wise here, here in this context to favor long engagements. And as you can see here, we stayed positive, histogram wise especially, up till, well, it was the first sign, it was around 12,500 or so, somewhere here, and we stayed positive. It was a first switch here. So that was at the beginning of, or no, it was mid, it was like, that was June, July 2021. So we stayed positive and thus had to favor, we should have favored long engagements here till here we topped out, rolled over, and that was probably then the signal to become a little, let's say, more careful when it comes to long engagements. So this is the MACD, a short introduction to that. So let's dig deeper into the slow stochastic here. And the little anecdote here is that I used this indicator when I started out as a professional trader at a professional trading desk, as a market maker for stocks at a stock exchange here, but was trading my small account. And I was wondering, I was talking to a trader back then at my desk, was a colleague, and asked what indicator he would favor. And he was like, well, not favoring any indicators at all because professionals don't use indicators. I was like, huh? Well, what are they there for then if no one of the big guys uses them? This is a very interesting second anecdote, in fact, when I was talking about chart patterns and so on and so forth. But in fact, really, like professional traders, especially those who are market makers and deliver liquidity, they don't look at indicators. They look at the order flow. They look at the tape in this case. They look at the times in sales. They look at how big is the buyer seller in this context and take this as their main information tool. They're not looking at an indicator which is derived from the price you can see in the chart. Back then I was like, well, okay, but still I want to use them. There must be a reason for them, and they were highlighted also in several books I read during that time, especially the one on technical analysis from Murphy, for example. So which is your favorite indicator? And I said, well, if I'd use one, I'd probably use here the slow stochastic. And I just entered it into my chart and used it based on this recommendation. And I wasn't really aware about these details, which I came aware of then a little later on, that, for example, the slow stochastic is a momentum indicator. And it's a still range-bound indicator between 0 and 100. And it shows the location of the close, in fact, the closing price here, relative to the high-low of the range over a set number of periods. So very mathematical, in fact. And what I'm interested in is, first of all, it's a momentum indicator. And then to some extent, when looking at the chart, it's kind of self-explaining. Here in this case, it's important to note that there's two lines we look at here. So it's a slow oscillating percentage K line, and then we have a moving average of this percentage K line. And this is the so-called percentage D line we look at. And we don't want to dig too deep into the formula behind this. That does make sense, but this is how you can think about it. And to make long thing short, it's like you can say, well, if here this blue line crosses the orange line, the orange dotted line, so if the moving averages crosses back above, the percentage D line crosses the percentage K line, well, then you have a buy signal. If it's here, or it's at least, first of all, it's an oversold territory against which you should expect the market to at least see a bounce against. Respectively, what you can see is here you have an bought environment, against which you should probably expect the market to see at least topping out. The only problem with that is, and this is something you will find out quite quickly, when using the indicator only based on oversold and overbought conditions, market can stay way longer overbought and oversold than you can remain solvent, to adapt the quote here from John Maynard Keynes in this context. But we can combine it and use this, in fact, here as our signal line. Before I continue talking, let me just here, I have to take some notes on two stocks I wanted to watch today, and I just have to see what the pre-market volume does in this context. So there's two titles I'm probably interested in, and which one, which stocks I'm looking today. So it's, first of all, it's Beyond Meat. There was a news with Kentucky Fried Chicken, who said that they want to use here their product nationwide, I think, making the stock potentially hot for today. And there's also Ford after the run yesterday. So we have 3.2 million shares, which were traded now in the pre-market. And inflection here is, by the way, $24. So if we can hold 24, that's a quite strong. And personally, I think this is a strong signal. And probably we are not yet done then on the upside. And probably Ford will make it up to 26, even though we already hit new highs, yearly highs, not just yearly highs, but also the highest level since 2001, based on some news on electric vehicles. Electric vehicles, you probably have seen the delivery numbers from Tesla. It's a very hot sector right now, and then Ford is trying to find some momentum within this. And so that's one of the reasons why electric vehicles are of interest for me in general, but also especially when it comes to Ford after the most recent price action. So let's come back here to the slow stochastic. Again, I think it's self-explaining. You probably look at overbought, oversold conditions, and then we have the third indicator. And don't misunderstand this. So it's very basic what we do right here, just to explain why we look at the indicators, and then we use this knowledge and combine it and have quite nice and fascinating way to use them in our trading. But first of all, we need to introduce them. So, and then we have the parabolic stop and reverse. It's probably one of the most fascinating indicators out there. In addition to that, I'm also using here the super trend, especially when it comes to short-term trading. When I trade the DAX here, super trend is very, very similar. What the parabolic stop and reverse in our case here does is, in fact, it looks at trends, and it's in fact, it's not just based on a mathematical formula spotting trends, but it's a trading system. It's a trading system, a complete trading system, which is not just showing us where a trend is right now, but also when to enter it, when to exit it. And it's stop and reverse. SAR is short for stop and reverse. So you stop then once a certain level is hit, and then the market reverses and you're trading the other direction, in fact. And so, well, it's very simple. Here, the logic behind this parabolic stop and reverse, again, no formula, no unnecessary details. It's like you say, well, when the dots are below our candles, our chart we look at, well, we take long positions. If it's above, then we take short positions. Easy as that. So means simply, remember here, for example, you probably say, well, we remember the MACD here switched. So once this news hit the wire, so you're going long and you keep the position as long as there's no turning around once we hit the dots on the downside, and then we switch to the short side. So as you can see here, in trending markets, it's a very, very strong indicator. It's horrible once we are range bound. Very important. So we have 3 indicators. So we have a parabolic stop and reverse as a trend indicator. We have the slow stochastic as our momentum indicator. And we have the MACD as the trend capturing momentum indicator, which is also trend based. So you can see all these indicators, they line up quite nicely, and they're looking at the same they're looking at the same market conditions here in this case. And now what we want to do is we want to combine them. So this is what we are after here. And so first of all, I now give you an idea on how to use the MACD and the slow stochastic, how to combine them. But then in the chart, we will see then, and where we'll give you the hot example right now with Tesla. I also put the parabolic stop and reverse as another filter, let's say, on top of that. So what we do is we are here using the stochastic oscillator as a momentum indicator, and the MACD as our trend capturing momentum indicator. So with the target, all in all, that we take both indicators now and integrate them in a so-called trend confirmation strategy. So this is what we're targeting. So we try to capture trends now, where we try to capture trends, respectively enter and exit these trends, and use these indicators here and combine them. So very important are the key parameters. So the chart I just presented when it came to the slow stochastic, that was the 1555. So we adopt this here a little, and we have 1444. So these are the key parameters. If you let me just go back into the MetaTrader and just give you here an insert, and then we are. So MACD with 12.26.9, this is a standard indicator. So you can just click OK. But in case of the slow stochastic, I just want to show you, where do I have it here? Is the stochastic. So here is percentage K. This is 14. Then you have the slowing period. This is 4. And then you have percentage D period. This is also 4. So these are the parameters you have to enter here. I'm not really sure. I think it's 533 and once you open it initially. So I'm not really sure, but whatever it is here, there should percentage K should be 14. You should have a slowing of 4 and the percentage D period of 4. And again, if you here take the MACD, MACD, so you can see here it's 12.26.9. So this is the standard. So it's the fast, it's the slow EMA in this case. So you remember 26, respectively 12 in this context. And then you have the MACD SMA here, in fact. So the moving average you put on top of that as a signal line. And so coming back here, so now we are just looking at the long scenario here. So you can accordingly adopt if you want to trade the short side. We only want to focus here on the long side with this. So what we do is we have the bullish MACD in this case. So bullish means that the histogram, so the difference between those two moving averages, 12 and 26, is greater 0. And then you have the MACD line, which is greater 0.2. So it crosses from below to above, and you have a positive environment in which the MACD line is trading to. And this is important. So it's not just that one condition should be given, but it should be both. And the second one is that we have the slow stochastic here, where the percentage K value passes the percentage D in this case. So we have this cross from the blue line up to the, or from the lower to the higher part of the orange line here. And what we then do is we enter the asset price on the next opening of the next candle here. And the stop, which is very important to calculate our risk, will be the last so-called identifiable candle. You will see that in the chart. You should make this dependable on, or dependent on how the trade or the chart looks like. So it's like you see, okay, this is the last low here. This is where the stop should be, because now if we drop the stop, well, we are out. And you keep the position once you see a cross back here in the slow stochastic. But that's makes more sense here to look here at an example in the real world. So what I did here, I prepared a chart where you have some signals which are already generated, and where you can see that it's extremely valuable, especially in a trending market. So you probably have seen these sharp moves higher in many tech stocks. So it's not just Tesla. You've seen this in Roku. You have seen this in Peloton. You have seen this in Zoom. So there's many growth stocks right now where you have these vertical moves, respectively. Sometimes you have them. Let's put it that way. Sometimes you have these vertical moves. Most recently, many vaccine developers, for example, went berserk, respectively, saw a sharp push higher, vertical moves like Moderna. So the move higher, for example, in Tesla last year, that was in December, was starting, I think it was somewhere around November. Once there was this announcement that Tesla will be included in the S&P. The idea behind this is very simple. Now you have many portfolio managers who are managing portfolios who are focusing on the ETF, who are focusing on the big market, or on the spider in this case, for example, so the S&P 500, and then they want to have the stocks within this index in their portfolios themselves. That's one of the reasons why then, if this stock, in this case Tesla, is included there, they have to get their hands on stock here, which is then resulting in strong demand, which is pushing the price higher without seeing a significant pull in. But sometimes it's only a consolidation then here, which is very difficult now to enter a trade. And here then such a system comes into play where you say, well, now I use an indicator which generates a signal which gives me better control, in this case, of when to enter the trade, when it's the right time to enter the trade. And once these conditions arrive, as you can see here, last time that was a Hertz deal, if I'm not mistaken. That was, let me just see, I think that was in October, shortly after earnings came out. And probably we're about to see something similar now, with delivery numbers being outstandingly good last Sunday. And now many market participants probably anticipating very strong earnings again at the end of this month. So it could be that this is the beginning of a push higher, and we probably will never look back, but instead push straight away directly up to 1,500 USD per share. Just this could be, but still, it's something where you want to try to participate in somehow, and you wonder, okay, it looks so extended on the upside, is it now the right time to buy? And here, given the system, sometimes you could spot really nice trading opportunities. So what you do is, you see here, the histogram, first of all, has to be positive. So in this environment, for example, with a negative histogram, so these bars, or respectively this gray area here below the chart, you don't want to be long. You want to wait until the histogram is positive again. And now what you can see is that we are about to cross here with this MACD line above the zero again. So very important, as of now, this hasn't happened right now. And this is the next thing here. You also want to see a confirmation in these slow stochastic here, so 1444. So that means now that we are probably about to see a top out similar to this one here, and then we see a next crossover. Now you might wonder, hey, but wait, I mean, we are here in overbought territory. Should I enter a trade here? Especially in growth sector, as you can see here, the stock can stay massively overbought for a very long extended period of time, as you can see here, for example. So just imagine, here we had a stock that was something like 300, 400, something like that, 500 probably, and then we nearly doubled from there. So that was after a split. Sure, that's something very important to note here, but still, we stayed for a long period, we stayed very overbought. And the same was true here once we saw this acceleration higher. So that was something like 600, 700 USD per share, and we topped out around 700. I'm sorry, 700, 1,200, 1,250 here. So nearly a double again. And this is something to keep in mind, because you stay in this trend as long as the trend is given. And this is also something where now these blue dots come into play. So the parabolic stop and reverse. You can see here, you stay in this trade. So you probably might say, well, I'm entering here. Okay, so we have a signal here. And then you can see there's sometimes a crossover back, and this is usually a sign to exit the trade. You can now adopt this and say, well, I know that sometimes we get to see these vertical moves. And given that, and knowing that the parabolic stop and reverse stays in these very extreme conditions really well, and sometimes profits massively from these vertical moves, I stay in the trade until I get to see here some kind of a reversion of the trend. And as long as the dots are below the candles, I stay in the trade. So if you combine these three indicators with each other, we can see that you can. It's not easy. So from a mental perspective, it's a very, very stressful environment. But still, you have more control, I think, in your trading. So it's not just that you think and wonder, hey, when do I enter the trade? Well, you enter the trade once you get the signal. And the signal is generated once you see the percentage K line crossing above the percentage D line. And if here the histogram is positive and you have a bullish environment from the MACD line perspective, and then you have a stop management here. Once you are in this trade, you have a stop management perspective, especially if the market goes vertical. Once you see here the parabolic stop and reverse being penetrated, the dot below the candle here, and then this is the moment once you take out the trade. So that's it. So in fact, that's it. Let me just here come into the summary first of all, and then let me just check the chat box first of all. If there's any questions. Okay, so yeah, Oswald is describing another way to use Fibonacci's here. So what I presented, so I think there's several ways to use Fibonacci's in your trading. I'm coming back to the introduction of this webinar, which has nothing to do with this presentation, but based on the question from someone who looked at the webinar, watched the webinar in the morning. So I think there are several ways to use Fibonacci's. What I just presented to you is just one way how to do that. And I think this is the first step. So based on that, you can then find out what suits your personality and your way to analyze the charts best. So for example, as you write perfectly right here, the ABCD pattern, for example, and once you have a bullish and bearish environment, yeah, so that's based on that. And then also interesting, a zigzag indicator. So it's also a trend following, if I'm not mistaken. So I'm not using it, but it's very similar to drawing higher highs, respectively higher lows here, and get trend structures, respectively structures in downtrends, if I'm not mistaken. So yeah, the summary for today. So the top three trading indicators. In fact, when I'm doing research, I'm also using a relative strength indicator. Probably we will do one in the future then, if you're interested. But given what I just presented to you, and given my overall still positive outlook, especially for growth stocks and these vertical moves, and the question which arises naturally, how to enter once the market has already seen such sharp moves higher as we've just recently seen in Tesla, for example, against 900 now, and with these strong deliveries. I hope you got some insights in how to use this in your trading. And very important, this is the second bullet point here is, you have to understand what each indicator stands for, and then how to optimally use it. So therefore, you need to know first if it's a trend following momentum indicator, and then try to combine and get the most out of it in such an environment. So don't use a trend following indicator once you're trying to participate in the range, for example, or try to trade the range, or the other way around. It just doesn't make sense and could result in some headache. So probably avoid this. Instead, use indicators which are trying to or which are going in the right or in one direction, and then try to use them as a filter, one or the other as a filter to optimize your overall entry and respectively exit management. And that's it for today. So I hope you enjoyed the webinar. These are the contact details from Admirals. So feel free to send an email if you have any questions, or feel free also to subscribe to the YouTube channel, set a reminder, post your questions in the chat box right below the video. And so yeah, that's in fact it. Very important, fully regulated broker. So we have to close here with a risk disclaimer. I hope you enjoyed the webinar, and I really look forward to the next webinar that will be next week on Friday. And that's it from my end. So all the best, happy trading, watch your stops. Talk to you again next week. I really look forward. See you. Bye-bye.